Our administration has a reputation for flip-flopping. So I'm not sure, to what degree can you take these announcements. Wall Street is waking up on rejigging the portfolio to having some hard assets. We saw countries like China and other countries that have weak currencies buying gold as a hedge. That will still continue.
Do you believe Kevin Warsh is fundamentally more bullish or more bearish for gold?
The thing is,
it's Tuesday, April 7th, and we're speaking around 1 p.m. Eastern Time. It's hours before Trump's deadline, 8 p.m. Eastern deadline for reopening the Strait of Hormuz. He's threatened to bomb power plants and infrastructure if this deadline is not met. And furthermore, earlier this morning at 8 o'clock, he made a tweet escalating these threats, saying that a whole civilization will die if this deadline is not met. What's going to happen? How should investors and traders react? And what's going to happen to gold and silver? We'll talk about these themes and much more with our guest today, Robert Gottlieb, author of Mastering Gold and Silver Markets and former managing director at JP Morgan. He spent over 3 decades at Citibank, HSBC, Bear Stearns, and JPM. And he's a multi-decade veteran at bullion banks on Wall Street. So very good to have you on the show, Bob. Thanks for being here.
Hey, David, thanks for having me. Interesting times for sure.
Remarkable times, and a remarkable tweet that President Trump has made just this morning at 8:06 a.m. Eastern Time. He's threatening a whole civilization. He says a whole civilization, I'll leave this on the screen, will die tonight, never to be brought back again. I don't want that to happen, but it probably will. If you're a trader or an investor, you look at a tweet like that, which is remarkable. He's basically threatening genocide at 8 in the morning. What do you do? Do you stay out of the markets, or do you put options on everything?
That's a great question. The thing is, our administration has a reputation for flip-flopping. So I'm not sure, to what degree can you take these announcements. I remember trading the last presidency of President Trump, and every day was, news headline generated, and obviously markets constantly pricing significant volatility based on the constant change of policy. So it's hard to say that, we will go through with this. I mean, we've had a few different deadlines already with Iran. So what this really does is, in the long term, is very fundamentally bullish for gold. However, in the short term, we have to warehouse and weather the storm as far as what's the impact it has on the short term. The short term clearly is rising oil prices, crude oil over $100, which then brings tighter inflation and higher U.S. interest rates. And so basically in the short term, what we are seeing is general risk off equities and gold as well.
How is it bullish long-term for gold?
Long-term for gold, this is bullish because I think in the end of December 24, I basically came up with the term of, I didn't come up with the term, but I used it, one of the earlier ones, the de-dollarization of the world. And with all our policies and the flip-flopping of policies and not knowing where the U.S. is coming from, we're seeing the central banks of the world basically diversifying away from the U.S. dollar by buying gold. I see that gold is the not just a hard asset and a safe haven asset, but probably the ultimate currency in the world. And that's obviously been evidenced by things that are happening with some of the central banks, like Turkey has used its gold at this high price to generate some dollar reserves because they're short a bunch of dollar reserves. You can do that without losing the gold appreciation by swapping out your gold reserves by selling spot, buying forward, and then just rolling those transactions. So I think right now we're in a very short-term, headline-driven world. But in the long term, we're in a de-dollarization world that has produced geopolitical and economic uncertainty.
If you take a look at my screen though, Bob, this is a chart of the DXY, and investors and traders have pointed out that ever since the beginning of the strikes on Iran, which is the 28th of February, the DXY, the dollar, has actually traded up and gold has traded down, which begs the question as to whether or not gold is still a safe haven against geopolitical risk, when in fact investors globally flock to the dollar, as evidenced here, in times of war and distress. Can you comment on this?
Yeah, first of all, I believe this rally that we've experienced, and I'm going to take that back to the end of 24 and obviously 2025. In the first half of the year, we probably saw the same similar chart of the dollar getting stronger. And however, what's interesting is traditionally gold goes up when the dollar gets weaker because it's cheaper in terms of foreign currencies. And when the dollar goes up and the dollar strengthens, gold used to go down, and that was because in foreign currency terms, it was more expensive. However, in this last big rally, especially in end of 24 or 25, all of 2025, we saw countries like China and other countries that have weak currencies and not deep financial markets actually buying gold as a hedge against their current currency. So I believe that will still continue in the sense that we'll see China buying gold and other countries that have strong weak currencies will use gold as a hedge against their own currency. I think in the long run, though, we're probably going to see U.S. dollar go down as interest rates go down, and in the long term, then we'll see the Western central banks come in and buy gold as well. However, most central banks don't make a decision based on price. They make a decision based on economic policy. I mean, I've dealt with central banks for 30 years, and it was the economic policy that drove them to buy or sell. And I believe that the central banks are still going to look to diversify away from the dollar, especially, with our U.S. Talking about where we are with NATO, on and off, and so forth. So I think long term, we'll still see the fundamental support to gold.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colomag are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Colomag spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. Late last year, well, actually not late, but third quarter last year in September 2025, CIO of Morgan Stanley, Mike Wilson, came out with a 60-20-20 portfolio strategy that includes 20% gold. So 60% equities, 20% bonds, and 20% gold, essentially splitting up the 40% bond section into gold and bonds. So a couple questions on this. Over your career working on Wall Street, how has Wall Street's attitude towards gold changed?
Yeah, I think this rally is not like no other rally in the world. It's not just Wall Street that has changed, except for we have seen, unfortunately, gold and silver become a momentum trade, and that's what triggered the January 30th sell-off, when the trade became way too crowded, and you couldn't put on CNBC without hearing every 20 minutes about gold and silver. So it contributed positively and then negatively, in the sense that the trade became way too leveraged and too crowded. However, the good part of it is that people are waking up to the fact that gold should be in a portfolio. Hard assets should be in your portfolio for long-term diversification. And that's where Morgan Stanley and others are saying, hey, I think, investors need gold in the portfolio. And while the World Gold Council probably say it's closer to 5 to 10, and I don't believe in 20 to 40 as a percentage, I do think that the world is waking up, and Wall Street is waking up, and investors are waking up into the role of gold. The other thing is that if you take a look at all total investable assets, and according to the World Gold Council, they did a study a couple of years ago, and there was less than 1% of investable assets were invested in gold. I don't think they've done revised that study. So with the higher prices, that's probably greater than 1%. But I do think that there's still a lot of room to get back into gold. Even if you take a look at the open interest on the CME, it's probably down 200,000 contracts from the highs.
The opening paragraph of this article from Reuters in September said that a 60-20-20 portfolio strategy that includes 20% gold is a more resilient inflation hedge at a time when U.S. equities are offering historically low upside over treasuries and investors are demanding higher yields for long-term bonds. Has this statement, or I guess attitude towards gold and the reason for holding gold, has that always been consistent over the course of your career in the last 3 or 4 decades? Or is this a more recent trend that major institutions, financial institutions, are seeing gold this way?
Yeah, I believe this rally is not like any of the previous rallies we had, and clearly, I think that's why this will be a much more sustained rally in the long term. Once we get rid of the negative headwinds of the daily headlines that we're receiving, because people are not just people, but as you said, Wall Street is waking up on rejigging the portfolio to having some hard assets. And based on gold, the question is, are you looking to invest as a hard asset for your portfolio for the very long term, or is this just a trade? And if it's a very long term and a hedge against your portfolio, you're going to look to take physical gold probably into your portfolio and put it away and forget about it. And I think there's been a lot of studies about that, and the gold and silver that's held around the U.S. in different depositories are held on a generational basis. So that, coupled with the idea of Wall Street now tackling what percentage should be in your portfolio, and investors still being way underallocated to gold, I think says a lot in the very long term.
Do you believe Kevin Warsh is fundamentally more bullish or more bearish for gold? Warsh is, of course, Jerome Powell's replacement at the Federal Reserve. And you'll recall last week on April 2nd that gold and silver futures fell on the day as data suggests, economic data, including inflation in the labor market data, suggests that perhaps the next Fed chair may be more hawkish than originally anticipated. This particular article wrote that by April 2nd, 2026, the prospect of a Volcker-esque regime, one that prioritizes price stability and dollar strength above all else, became the dominant market narrative. So my question is, do you think the next Federal Reserve regime, led by Warsh, is going to be more of a dollar hawk?
Yeah, I think that that was the fear when, unfortunately, it was announced on January 30th by President Trump about Warsh coming in, and that obviously helped exaggerate that tremendous violent sell-off. However, I do think that even though Warsh has a hawkish reputation, and it's clear that the price of oil being where it is today is going to have a hard time getting U.S. dollar interest rates down, I do think that President Trump wants lower rates, and I think that Warsh at one point will probably accommodate that as well. except for right now, I think that why we're seeing gold where it is and the way it's reacting is with it's very hard. It's very hard for the people to think about rates coming down while the inflationary pressure of oil is creating a higher for longer right now. However, I think that pressure eventually will dissipate once we can see our way past the Iran war, and if oil starts coming off significantly, I then think that Warsh will have the tools to actually lower rates, or maybe not as much as was anticipated several months ago, but I think that they'll take some pressure off the market.
Over the last week, the market has witnessed outflows in gold ETFs. So according to this particular source, this is from markets.financialcontent.com, the fallout has been nothing short of historic. The SPDR gold shares, the world's largest gold ETF, witnessed a staggering $1.08 billion in outflows over the last week alone, while the VanEck Junior Gold Miners ETF GDXJ suffered 5.6% losses in a single session. Now, when you're seeing outflows from gold ETFs of this particular magnitude in this short amount of time, is that rebalancing, or do you think that's just basically recapitulation of the entire gold sector?
No, I don't think it's recapitulation of the entire sector. I believe that people, investors, are on a general risk-off basis, and that if you have profits in the gold, and you have some in equities, you're going to take it off the table today. I mean, it's only wise in the sense of nobody can navigate these headlines as far as where we're heading till we get there. So I believe that people are just being prudent and taking chips off the table. I do believe that this volatility in headlines and is fundamentally long-term bullish, except for you still have to navigate the short-term news headlines. So I believe that we will have to I think it's healthy that we're taking that positions are coming down. That means that eventually that there'll be plenty of room to put positions back on.
This leads to a discussion about your book, Mastering Gold and Silver Markets, Insights from a Legendary Bullion Bank Trader. You've worked at bullion banks for many decades, like I alluded to in the introduction. And in this book, readers can find a detailed explanation as to how bullion dealers and bullion banks operate. What are some goals that you aim to achieve in terms of educating the public? What do you want the public or the reader to gain from after reading this book?
Yes, that's a great question, and I'm glad you asked that. There's been a significant amount of misinformation as far as what bullion banks do. The biggest piece of misinformation is that people look at the Commitment of Traders report and see that the swap dealers are short the CME in gold and silver. So if it's short 200,000 ounces or 200,000 contracts or whatever, people then say that the banks are short the world supply of gold and short the world supply of silver. If that was true, and silver went from 26 to 120 and gold went from 2,600 to 5,500, the banks would have had like $100 billion in losses. The fact is that wasn't true, and that the bullion banks themselves are short the CME, but they're long the London OTC market, long lease rates, long OTC forwards. So what they do is they have arbitrage on. They borrow gold by buying spot London and sell CME futures. So they are actually flat and not outright short. So what I'm trying to do in my book is educate what bullion banks actually do. The bullion bank is like a center of a tire if you have all the spokes. And bullion banks are there to facilitate business in gold as far as financing mining companies, hedging mining companies, financing consumers, for instance, jewelry manufacturers, refiners, and so forth. So the banks go in there and borrow gold from central banks, or they borrow it from by generating in a bullish market. You buy spot and you sell the futures, and then all the leveraged funds that are on in the futures market, they don't want to take delivery. So when the nearby month gets close, they'll roll their long positions. So the banks take the opposite position. They're short the CME, and then when this hedge funds are rolling their long positions, they're taking the opposite positions. They're buying the nearby, selling the long dated, and through that process, the banks can actually borrow gold at sometimes negative interest rates. Never mind positive, not even a lease rate at cost, but because it's such a bullish market, they could generate these contangos above money, and then they use that to finance their the mining companies as far as long-term hedges, and then again the consumers as well. So hopefully my book will educate people on what bullion banks actually do. And the first half of the book is memoir, so it takes you through my trading from starting in the vault, learning from ground zero per se in the physical market, to becoming a trader, and then helping central banks between financing countries, acquiring gold reserves, or even disposing of gold reserves. So, and then of course, the latter part of the book is talks about fundamental supply, demand and supply. For instance, we spoke about gold being a great asset, a safe haven asset. Silver has been in a 5-year demand supply deficit. So, take a look at silver. For the last prior 5 years, the demand supply has been about 100 to 150 tons. In 26, it's going to be forecasted maybe 67 or 70 tons of a deficit. With that, it all goes into, for instance, demand in solar, PVs, AI, EV, data centers, and microchips. So there's this silver being different than gold, is an industrial metal. It's become a critical mineral, which is very important. The U.S. is looking at possibly putting $12 billion into critical minerals. It's still not known yet how much of that will go into silver, but I believe that silver is still also as a physical hard asset and a safe with safe haven status as well. So it has the industrial demand and the safe haven asset, which makes it unique versus gold. So I am long-term bullish both metals because of that.
The CME just raised the margin requirement on silver and gold futures by 30%. This is the beginning of April. Can you comment on this development and how that impacts markets?
Yeah, I mean, the CME, this isn't the first time. I mean, the CME was raising rates, margins all through the end of last year. And they have to keep the integrity of the market as far as, based on volatility. Volatility at the end of last year got to over 100%. So the CME needs to protect all the investors on the CME, and especially if you have highly leveraged investors, you have to make sure that they're able to make those margin calls. So they're just protecting the integrity of the exchange by doing that.
Right, but is there any material impact on traders and investors when margin requirements are raised?
Well, it really depends on how levered those customers are. I mean, if you have large profits in it, you're only posting against your profits. But at times in the past, if we take a look at the Hunt brother positions, and then the 08, 011, when we had the run up on what we call the Reddit rally after the financial crisis. Those two rallies were not really fundamentally driven. So in those cases, when the CME raised margin, it had a much more impact on the market because it was just those levered customers that were in there, and there weren't as many fundamental reasons behind, those long positions as far as other counterparties. So in this market, I believe that we don't have we've cleared out a lot of that levered customer base. So I don't believe that raising will be as dangerous as it was in a situation where everyone, was levered.
The Chinese have been accumulating silver. Some reports are citing the Chinese are importing 206.7 tons in the first 2 months of 2026 alone. This is surging to a multi-year high. Why do you think China is accumulating so much silver?
Yeah, well, obviously there's solar demand, and there's also investor demand. But the thing is, silver physically goes to where it's needed. If we take a look at 2025, after the elections of 24, the Trump administration threatened tariffs. So what happened was that, and in fact, they imposed tariffs and initially in March as well. And basically we saw the CME warehouse stocks go from 250 million ounces to 533 million. 283 million ounces was shipped into the CME from overseas. And only in the last several months have we seen that go out, as once it was clearly stated that there won't be tariffs put on silver. And basically, we've seen now roughly 206 million ounces of silver go from 533 million to recently 327 million ounces of the CME. That 206 million ounces has made its way back both to London and to China. The physical silver goes to where it's needed and where the arbitrage has created that pain. As far as in China, I heard that 49 silver was going for a 50 cents premium. So many banks were taking silver off the CME and taking high grade 49 silver and shipping it into China, and making that arbitrage and making that profit. So that's why we're seeing that we saw a significant amount of silver depleted from China and depleted initially from London, because there was a need for 1,000-ounce silver bars in the U.S. and also significant amount of silver being bought in India during the wedding season, and then the ETFs. So those things are just go in cycles. And so today the cycle is that the silver was depleted out of China and now is getting replenished.
When you look back at the Hunt brothers silver squeeze, it was commonly believed that the Hunt brothers squeeze the silver price. That's been debated in itself. But going back to today, do you see any actors or entities that may replicate what the Hunts supposedly did in the early 80s, which is to corner the entire silver market today?
Yeah, I believe that the CFTC has changed the rules, and I don't think anybody can actually corner the market like they have in the past. So those rules basically have been changed. But what we are seeing is obviously a bullish move into silver, and from early of 25 to today, it got ahead. The silver rally got ahead of itself, and basically bull markets don't die from corrections. However, excessive leverage and blind consensus creates violent corrections. So that's why we saw these that initial correction on January 30th, where silver went down 30% at one point. I do believe that on long term, that silver is following gold today, and eventually will take over on its own based on those important characteristics.
Do you do price projections, Rob? If someone asks you, hey, where do you see gold or silver headed? How do you even answer that question?
Yeah, I don't believe in short-term price targets. I believe we're in a structural shift today that's redefining the role of both gold and silver. And I believe that clearly investors have woken up as far as it's part of a global portfolio, and that people are waking up to hard assets, as a critical part of that portfolio. However, I think that anytime that people have made price predictions, it's always happened for a different reason. For instance, COVID, nobody could have forecasted COVID. And so we had a COVID rally in 2020, but for whatever reasons that people forecasted gold and silver up, it wasn't because of COVID. The same thing with tariff threats. I don't believe that, anybody believed that or could have seen the Trump administration coming in and then threatening tariffs and then having that tariff rally. So in that case, I don't believe in coming up with a price, but I do believe that we're in a long-term bull rally because we're still in geopolitical and economic uncertainty, and that silver, as I mentioned, has its own special ingredients, being an industrial metal, a critical mineral, and industrial and supply demand deficits as well. So I do believe that, and that gold, of course, I think central banks will continue to buy over the long term. We haven't seen a recent study. I think a year and a half ago, we saw World Gold Council do a study, and 75% of the central banks said that they would continue to buy gold over the 5 years. So I think we need to, see a new one based on especially the issue with countries like Turkey and the Strait of Hormuz creating dollar squeezes among some central banks.
So when you see a headline like this, well, this isn't even a headline. This is directly from the JP Morgan website. And JPM isn't alone. Lots of banks on Wall Street have been giving forecasts, and a lot of them have been pretty bullish. Goldman Sachs, for example. So here is from JP Morgan, December 2025, looking ahead, the 2026 and 2027 outlook for the metal remains bullish. Prices are expected to push towards $5,000 an ounce by the fourth quarter of 2026, with $6,000 an ounce a possibility longer term. So two questions. One, how do bullion banks give or arrive at a forecast? In other words, what is the process in which they make forecasts? And two, going back to your original point, people do it for a reason. What is the reason for which bullion banks release their forecast to the public?
Right. Well, first of all, these forecasts come from the research department, which research and trading, were and are significantly Chinese wall.
Yes.
So I really didn't get involved with these forecasts per se, but obviously they do a lot more long-term research. They look at supply, demand, and so forth, and obviously to the degree that a bank will be successful in their research, obviously will attract investors to trade within those banks.
Well, when you look at bank reports on mining companies, when analysts on the sell side research mining companies and do a cash flow analysis, a DCF on the company itself for valuations purposes, you'll notice that in most cases, the gold price assumption is much lower than the current spot price. Doesn't matter where the spot price is. They always use a more conservative number. Is that just a bank practice, or is that because of market sentiment and investors don't think the price is here to stay, you think?
I mean, that's a good question. Unfortunately, that I never really got involved in the research department, so I really can't answer why they have that practice.
Okay, excellent. Well, Bob, give us a few more final takeaways from your book. In fact, probably some of the most interesting facts about the gold and silver market that perhaps you didn't know before you wrote the book and you learned during the research process.
Yeah, I mean, clearly I wasn't in tune as much with the demand supply, especially in the silver, and how many different uses there are in the physical industrial demand. The other thing that was interesting was there were some studies that said there's enough silver in the world, and that the silver tightness shouldn't exist. And what I actually found out that that there are warehouses in the U.S. and in the Midwest and Texas, and a lot of that silver I found out is what's called generational silver, and that silver really is never going to come out unless it gets willed to a generation, and then that generation decides if they're going to keep it or sell it. And typically, for most part, that silver never actually comes out. Then the interesting part on the demand supply in silver was that Dan Golly, who is a TD analyst, did something on free floating stocks. And in London, the free floating stock is what's available to trade. So for instance, let's say you had 800 million ounces in the silver warehouses, but 500 million ounces of it was allocated to ETFs. Well, in that case, there was only 300 million ounces physically available to trade. What happened was during the time of tariffs, I mentioned that 283 million ounces left overseas and went into the U.S. Well, that 300 million of free floating stock went down to 100 million ounces of free floating, while the actual daily trading went from 250 to 350 million ounces. So the demand on the daily trading significantly increased, while the availability of actual warehouse clearing amount, significantly decreased. And what happened was we had tremendous backwardation, and lease rates in September and October went to 30%. And for 3 months. And so backwardation of OTC forwards went to minus 25%. That in itself was, super bullish, because consumers that would finance themselves with leases could no longer use leases and would have to outright buy the metal. Also, what happened was the overnight rate got so tight at one point it went to 150% backwardation. Not 1.5, not 150 basis points, but 150%. So all these things contributed to this tightness contributed to the overall bullishness. And despite the fact that there's enough silver around in the world, if the silver isn't coming out, it could create these significant shortages of silver, in different pockets of the world. I found that to be fascinating.
Final question, Bob. Do you ever see the world heading back to a gold standard?
I never like to say never. I don't believe that we're going to go back to the gold standard. However, I do believe that gold has, clearly playing a more important role. For instance, if you take a look at whatever gold is produced on day one of this world and what is held by central banks, or approximately, according to the World Gold Council, 18% of whatever's been produced from day one is held by central banks in their reserves. And that, if anything, is a very deep pocket holder of gold. And then if you take a look at what supply comes into the world, being between mining, new mine supply and scrap, that only adds 2% to the supply. So I think that gold is very scarce in that terms, and that will be fundamentally bullish for gold in the very long term. So I believe that we may not go back to the gold standard, but there's no question in my mind that central banks are only increasing the amount of gold being held in their portfolios. And with the Wall Street getting on, as you mentioned, onto the bandwagon and advocating for higher percentages in portfolios, I think that also bodes well in the long term for gold.
Okay, thanks, Bob. Tell us where we can follow your work and stay up to date with your writings.
Yeah, well, obviously, my book is out. It's available on Amazon, and then I put out LinkedIn posts for many to see. And what I've realized is that between my LinkedIn posts and my book, that the world still needs some institutional website platform. And so I am co-founding watchgold.org, which will have gold, silver, and eventually PGMs. It's going to have a bunch of research on it, as well as all the data points in one platform. And it's going to be an institutional-based website that's backed by the gold and the World Gold Council. It's going to allow us to put research. Silver Institute's going to allow us to put research on it. And we will also be putting independent research on it as well.
Okay, thanks a lot.
Thanks a lot, Dave.
Thank you for watching. Don't forget to like, subscribe, follow Bob in the links down below.